you guys for being on time. All right. So thanks for attending the official launch call of the fourth Jones Fiduciary Wealth Management Real Estate Access Fund. I think there are going to be plenty of people on this call that have not really heard much about the fund in the past. So the first thing I'll do is just kind of let you guys know this is nothing in this presentation is meant to be advice, tax planning advice, or it's not even an offering to invest. If you want to consider investing, you should look at the private placement memorandum and make your decisions once you have all the appropriate information in front of you. By the way, all that information is available already, so we can get to that, or we can talk about that immediately following this call if you like. So I'd like to back up a second and just let you know, 1 second, getting a couple messages. I want to make sure everyone can sign on. Okay. So I started this real estate access series of funds in 2021. And really the point was, the mission is to provide direct access to professional real estate investing so that investors can gain access to the value creation, diversification, tax benefits of real estate while passing the expensive years of personally learning the ropes and many multiple layers of fees that usually exist in publicly traded real estate funds, REITs, and crowdfunding. Matter of fact, I thought about making the tagline that this is like crowdfunding except for without all the fees. So the mission is very intentional, as you might imagine. There are many people on this call that have lost tons of money, almost millions, especially definitely over millions if you add them all up, and even been scammed out of money directly with the intent of the scam from the beginning, while trying to invest in what they thought was a good real estate deal. And there's people on this call that bought a piece of real estate because they just knew they wanted to start investing in real estate. And there's people on this call that regret their initial effort to invest in real estate because they bought a property that ended up being either not a good investment, or they bought a second home that they don't use that much, or something else along those lines. And the bottom line is that they did this because it is no secret that real estate in the United States is the most common asset held by the wealthiest people in this country. And not only that, but almost everyone knows, at least one person, probably a handful of people that specifically made their wealth from the beginning using real estate. And so it's not a secret. I mean, people generally understand that and know that. The problem is that it's a very steep learning curve. It's still pretty mystical creature when it comes time for people to start understanding how to invest in real estate themselves. And there's a decent amount of risk. And of course, there's no such thing as a passive investment, especially when it comes to real estate, if you're going to own it yourself. So providing that direct access to professional real estate investing is just that. We want to bypass all of the learning curve and get right into the investments that the most advanced investors are already investing in. And we want to get all the same benefits. We want to get the value creation of diversification, tax benefits, maybe even take advantage of leverage, which is a very key point of these funds. The fact that you can invest in real estate and obtain the advantages of leverage without ever having to sign personally for any debt. That's a huge benefit to investing in these funds. Some of the funds don't have debt, but where it is beneficial to use debt, the end investors have not had to sign on the dotted line. And so one of the main things that I have from the very beginning wanted to make sure of that the layers of fees that I was seeing in the other options that are available to investors, mostly through crowdfunding, and even your average REIT has just so many layers of fees that it just really waters down the returns. And at the end of the day, you're giving up liquidity of your liquid cash. You really need to obtain the full benefit and not get feed to death. Those things, real estate generally provides good cash flow, but if you're being feed to death on the backside, it's just difficult to make the returns work out. So the objectives of the REIF series are to generate income in excess of that of the traditional stock bond portfolio. So the whole point of doing this was I wanted to myself invest in real estate because I expect a higher rate of return than what I can in stock and bonds. Generate total returns and cash flow, both compared to what we want to do or what we expect in stock bonds, and to pass through those tax benefits. So I owned real estate personally prior to this, and so those tax benefits are, I understood them, and I wanted to make sure that those stuck around even through this method of investing. So the standards that we have maintained through this series of funds is that we have a limited partnership structure, and that keeps everything completely passed through. Everything that's available to you if you were to invest as an individual is available to you investing through these funds. When I say invest as an individual, I mean if you were to go buy these same assets personally, you're going to get the same tax treatment through these funds as you would investing in them personally. All the portfolio investments pass an internal fee evaluation, so we need to make sure that it is not laden with fees. If you go, anyone that's looked at those crowdfunding, sites, or even inside of REITs or a lot of these other, even non-publicly traded funds, you'll see things like there's a acquisition fee for each property. There's a dissolution fee for each property. There's a debt acquisition fee for each property. There's just fees and fees and fees, and you can hardly imagine that they are charging that many fees. So one of the things that I do is I go in and make sure that, we're not just paying the fees for the people that are making the most profit. And so we have a standard there of making sure that we're screening that. Another thing that's important is for the general partners to have enough skin in the game. So if we're just, again, there's a lot of vehicles out there where it's real easy to give them your money, and that's the only thing that's invested is other people's money. And so everyone knows that you treat other people's money different than your own. So if these general partners don't have enough skin in the game, it's really just, in my opinion, it just adds a whole nother element of risk, and it changes the way they're going to make those decisions. So we want them to have enough skin in the game. And there's a couple different ways they can do that, but the bottom line is they need skin in the game. These funds are all independently audited. They are all independently administered. And as the general partner of these funds, so Jones Fiduciary Wealth Management is the general partner of these funds, and the general partner, myself, there is no profit being taken by from these funds. So whatever the profit is, all goes to limited partners. The only thing that is the only other money that goes out is our proportionate share of the auditor and our proportionate share of the administrator. All right, so those are the standards. So what are the trends and opportunities that we are looking to take advantage of right now? Probably, if you've been on the waiting list, you've gotten a little bit up to speed on the extreme housing shortage that currently exists and is expected to worsen. There is a very disrupted lending environment, and there is a trend of data centers, large corporations divesting their data centers. And so this fund intends to take advantage of those trends. So the housing shortage, there's about anywhere between 3.5 and 8 million units in the U.S., a shortage, and it's expected to substantially worsen over the next 10 years. A number I heard was 30 million units over the next 10 years, which is just unbelievable. And everyone knows about the interest rates, how they are higher and higher, but also not likely to return to previous levels. And so the demand for rentals is improved or increased in that way. But also, even prior to the rate increases, we saw a huge demographic trend towards younger generations and older generations. So would-be first-time home buyers and also retirees are just sick of owning. They don't want to be locked down. And it's possible even the job market requires them to stay more flexible. And so all these things are leading to a housing shortage, specifically on the rental side. The disrupted lending environment. So probably most people heard of Signature Bank and Credit Suisse and all the problems happening in the banking industry a couple of years ago. And basically all of that has amounted to regulators tightening the screws on banks, and it especially affects regional banks that have seen large decreases in deposits. And so when you get larger reserve requirements on some, if not all, assets, and then also smaller reserves in the form of deposits, then obviously you can't lend as much. Now, couple that with the idea or the fact that there's 1.5 trillion maturing in commercial assets or commercial loans over the next 3 years. Roughly a third of that is currently lent out by regional banks. And so what we're seeing demand over the next 3 years where that 1.5 trillion is going to roll over and need to be refinanced, in addition to projects like we're going to talk about, new projects. There is a increased demand. Well, the demand's probably steady, if not a little bit decreasing, but the supply is severely retracted. So anytime you get demand outpacing supply in a significant way, it creates an opportunity. And that doesn't matter what industry you're in, demand outpacing supply creates the opportunity. So those are the places that we are going to concentrate on. So lastly, let's talk about large corporations divesting from data centers. So, everyone knows that everyone carries around a phone now. It's mobile devices, video traffic, imminent commercialization of 5G. Demand for data is already monumental, and it's expected to accelerate over the foreseeable future, especially considering artificial intelligence. It's probably not even conceivable in the ways in which artificial intelligence will affect data. But in spite of that, large corporations are seeking to sell their assets to buyers and then lease them back. And the reasons are data centers don't generate revenue. It's just a cost for them. And by this time, all the depreciation is taken on those centers. And so it's just kind of an asset sitting there that they have to hire people and pay benefits on and payroll and, all the maintenance. It's not an efficient business model for them to continue doing that. So companies like Coke, and there's dozens and dozens of them are divesting all over the world. And so there are main buyers of these things. And I think that that's one of the ways that we can take advantage of the increase in demand for data and data centers, especially as I think it's one of the best ways to take advantage of kind of the AI wave, where we don't have to figure out who's going to win that battle. Whoever wins it is going to need more data centers. So, all right. So the fourth fund here intends to take advantage of the current worsening shortage of housing in the United States by investing in a majority of the assets in multifamily projects located in Delaware and the Southeast. The demographics, along with the competitive advantage and the intimate familiarity of our partners in their respective markets and strategies, combine to reduce execution risk and capitalize on the well-established and strengthening trends. So that's essentially the thesis in a nutshell of this fund. We intend to concentrate investments in with Jack Lingo Asset Management. We have got Doug on the line, who's going to field questions with us and for us to the extent that there are any. My first 3 funds were exclusively invested in JLAM deals, and we can get into I guess at this point, intimate relationship. Well, first of all, I've known Doug since we were in 5th grade, but and so we're taking advantage of our strengthening and already deep and deepening relationship with JLAM, as well as some other sponsors and partners that I've had the opportunity to vet out for my own money, which means if I'm happy with it, my own money, I'm happy with for my investors. And so that's how we're going to take advantage of that. And then there's a few different strategies throughout that we'll discuss on how we're actually going to take advantage and in each of those strategies. In any case, this fund intends to offer immediate diversification with one investment. With my first 3 funds, it was nice because we got to really evaluate the specific deal at hand. The bad news was it wasn't diversified, and with the minimums of these funds, that can be an issue. It's difficult to spread that out. So we are going to target gross returns of each asset that we buy inside of this fund, each portfolio investment, 15 to 18, some more, but to the extent that it's more than that, I'm not going to say that I expect more than that. And so that means that I'm targeting 14 to 15% net to investors after all expenses and all fees. My fee, by the way, in general is 1.25% of the fund. I do not take, as I mentioned before, any profit. And so what that means essentially is that what I'm trying to maintain is the integrity of the fact that I really don't care if you invest in this fund or invest in the stock market or invest in some other fund through me. My fee generally is the same. I am not getting additional benefits by starting these real estate funds. They are really just the benefit for the benefit of my clients to gain access in these ways. The transparency is there. We have reporting on a few different levels, and we've already mentioned the fee conscious nature. I guess I sort of jumped ahead on that one. So starting immediately, we're taking round 1 investors, and you have to be an accredited investor, and I have to verify that this time around. The first couple funds allowed a certain percentage of non-accredited investors, and the first round commitments will have the capital called right up front. There's no waiting around to get it deployed, and so that's pretty nice. So at this point, I will open it up to questions. I purposely went through that quickly because Doug, who probably I'll lean on for some of these answers, is in Hawaii, and I think he's got a surfing lesson or something. I don't know what he's got, but anyway, so please, you should be able to unmute yourselves, and to the extent that you have questions.
Sean, this is Pat Joffrey. Is there any assets that are specifically targeted, or are you guys assembling to then go find assets, or do you guys already have things in the sites and things will move quick?
Yes, we have all the money that is going to be called up front. We have a designated investments. We have designated breadth of investments for that to be deployed immediately. I'm not going to ever call money and just let it sit, because at the end of the day, that's going to drag returns, which is what ultimately how you guys are going to evaluate this in the future. So yes, the first investment, one of the main first investments will be an investment in a multifamily built from scratch, as opposed to rehabbing, some older thing. So that will be the majority of the initial investment. It will also be accompanied by another strategy, lesser so, maybe 10% of it is going to go to immediately to a fund that invests in or is already invested in multifamily assets in the Southeast. Those will generate cash flow immediately, but the main first investment will be with JLAM in a build for rent project that they have going on.
Hey, Sean, it's Denise Manelli, but just so I'm clear, you were talking about large corporations divesting themselves of data centers, but then when you went into the description of what this fund is going to invest in, you went into multifamily rent to build. So there's not a connection to this particular REF4 related to the data center divesting?
There is, and I probably just blew through that too quickly. So this fund is going to be about 70% projects with JLAM, and there are about 6 projects highlighted. We'll probably end up doing 3 or 4, and so that's going to represent it's going to represent the majority of the fund. I'm guessing around 70%. There's no mandate around that, but I believe it's going to be around 70% of the fund will be JLAM deals. That all of those deals will be some form of build to rent. They could be an apartment complex, could be a community that they're building individual lots and holding the same community, or townhomes, some version of all that. But so that will be 70%. Another, say, roughly 15% will also be multifamily. 10 to 15% of that will be, that portion will be with another partner that the way that they do it is they buy existing 90s vintage, very large apartment complexes, and they have a well-vetted strategy for generating cash flow right away and turning those over. They are on their 4th version of that fund. And so I've been able to gain a lot of confidence in that, and a handful or more of my clients have invested in that directly as well. And then roughly 10 to 15% will be the data center strategy.
And who would you be partnering with that? Is that a third organization?
The multifamily, the apartment complexes in the Southeast is going to be Carter family of funds, as is the data center.
Oh, okay.
And that's Critical Infrastructure Fund is what it's called. But we've been able to determine that, all the standards that I mentioned earlier are there, and, we visited them and kicked the tires and figured out that it's worthwhile. Thanks. Sorry for blowing over that.
No worries. Thank you.
Sean, this is Ted. I've got a question. Construction costs, are they, how do you address those? Everything seems to be, you get into it and then the construction costs are a lot higher. Does that come into play here?
That's a good question. Ted lives in the Northeast and is used to all the union crap that goes on. So that's why that's the first question he asked. But yeah, well, what you're really speaking about is the ability of the sponsor of the deal itself to correctly project and or limit increases in those projected costs. And so JLAM has demonstrated that they have the ability to remain within their projected costs, both in, well, my experience has been in 2 of their deals, and they have not only been able to describe how they limit those projected costs, but they have been successful limiting those. So I guess in the end of the day, you have no guarantees that if you're just giving money to some random person, you don't know how they're going to do that. But generally, the way that I've seen them do that, and Doug can maybe comment on this, is they're entering into contracts that have maximum numbers on them from the beginning. Doug, you want to just go ahead and address that? How you deal with the potential for increased construction costs on these?
Sure, and great question. Definitely timely. We've seen construction costs from a macro perspective really normalize over the last year. Supply chain issues are much lesser than they were a year or 2 ago. But our methodology of controlling them and managing expenses kind of has been consistent even before we got into COVID and those situations. So, when we're looking at a new project, it's important for us to make sure that we capitalize it appropriately. And so, we need to carry appropriate contingencies for changes in costs. And then we also apply, different tools to manage those costs, typically on the front end. And that's largely driven by the contract structure that we enter with our key trades or our key, construction partners. Those are typically, as Sean mentioned, the guaranteed maximum price construction contract structure. So we have an upward limit on what that can cost. But if it comes in, the actual costs come in underneath that, then we have an aligned interest with our contractor in that we share some of those savings with them. So that keeps, their interest aligned to try and, manage costs along with us. So we make sure that, we've got that contract structure in place and that's appropriate for the specific situation. But then also we're carrying and capitalizing our projects in a way that can accommodate if there are, things that weren't expected or unforeseen changes in the cost structure without creating an issue for the project.
Good question, Ted.
And to Sean, to your point, we don't in central and southern Delaware, we don't really run into union issues either. So it's all pretty much private contractors.
Right. Private contracted. You guys are big enough and have been doing this long enough where these builders know this isn't the first job they've probably done for you. It's not going to be the last job they've done. And so it's a lot of this is relationship based, Ted, where, these are transaction at arm's length and they're being negotiated in good faith and they're just strong relationships. I mean, that's the ideal. Obviously nothing can be perfect all the time, but those are the mechanisms in place. Thanks, Doug.
Hey, Sean, it's Anthony. I may have missed this, but are you preparing to have a marketing book on the fund that will go over projections and anything cost related for potential investors?
Yes.
Okay, cool. Thank you.
All right. So feel free to interrupt me. I'm going to fill the silence with a couple bits of information inspired by Anthony's questions. So the costs to the investors there's some flat costs for roughly $17,500 for the fund itself for administration, and then about $12,500 for taxes and audit, which are really it's not bad at all. There are some taxes that are paid at the fund level. Most of those have been flat taxes, a couple thousand here and there. So with this fund, I'm anticipating it being, somewhere between $7.5 and $15 million. And so when you do the math on those flat costs relative to the amount of funds inside the investment, it's really being spread out. So my goal was always, I mean, from the beginning, my goal was to keep these all-in costs inside the fund to less than 2%. My fee being at 1.25, and those other fees should end up being less than around 0.5%, but certainly no more than 75 basis points. So I think if you looked at, what the gross returns are from the investments being, the target being 15, we'll just call it 15 plus, that means that you can roughly expect to see a return as an investor at, somewhere around 14 to 16. So that's where those numbers come from. So that I don't confuse anyone, if you were going to take 15 and subtract the 2% that I just said, you would get 13. But I'm buffering up because I know that some of these investments that we are anticipating are going to be towards the 18 to 20% target. So just keep in mind that the target for your return as investors is 14 to 16, and that's roughly 2% cost. Is that? Would you care to expound on your question after those comments, Anthony?
No, thank you for providing that.
Okay. Yeah. So, yeah, I mean, the whole point of this is keep it very simple so that, to just keep it simple so that we're not sitting there trying to do all kinds of mental math figuring out how these operations work. Basically, distributions come in from the partners, from the deals we've invested in. Once a quarter, my administrators or the fund administrators are going to go in and they're going to figure out what money came in, what expenses to set aside, because those expenses I mentioned only happen annually. So they account for them quarterly and they set it aside. That balance builds up, and then at the end of the year, they write the check to those individual vendors. And that's it. So it's really just those two vendors are the expenses and the management fee.
Sean, do you have a target for the total dollar value of this particular fund and what the minimum amount is per investor?
Yes. So the target, I think the target is above 5 million. I generally make those targets low. I think it's likely to be, as I said, somewhere between, it's probably more likely to be closer to 10 million when it's all said and done. One thing I've done with this fund is instead of, opening a new fund every single time there's a deal, I have structured this fund so that I can open it back up and take in new money into this fund. When that happens, those investors will be paying the initial investors interest from the beginning. So it will, they're coming into the fund, they're helping defer the costs, and what happens is they defer those costs as if they were there from the beginning. So it's a benefit to everyone all the way around. Helps us buy more assets, continue to be diversified. And so the first round of investing, I'm not sure if this is what you were getting at, but this first round, I'm thinking will be somewhere between 3 and 4.5 million. And you asked the stated minimum in the documents is 100,000. So aside from being able to open back up and take other investors, it's very similar to the previous funds, for anyone that was involved. One other thing I'll mention is that, so far, all of the investments that I have been reviewing and am considering for this fund have some version of a preferred return, which means one of the ways that you keep the general partner's skin in the game is you want that preferred return to be as high as possible, because that is generally when they don't take either any profit, ideally, or they take very little portion of their profit until that preferred return has been earned. So in some of them, the preferred return is as high as 12.33%. In some of them, they're as low as 6%. But in any case, those returns are basically how we keep the skin in the game. One of the ways we keep the skin in the game from the sponsors of those individual deals. On my fund level, so on the Access Fund level, this fourth fund, just like the rest, it doesn't really make any sense to have a preferred return because I'm not taking any of the profit anyway. So there's no reason to stipulate a preferred return over which, it's just all the profit is divided to the investors as soon as it is realized. All the cash flow actually is, so a lot of what comes back is return of capital at first. We don't even wait for there to be profit. As soon as cash flow comes back, we distribute it, with maybe some minor holdbacks for expenses or whatever. Thanks, Denise.
No, thank you. No.
So I anticipate being able, one of the benefits of having intimate, I guess, scene like this is I anticipate being able to have specific conversations with each investor, especially in this first round, to cover either things that you don't want to ask right now, or maybe you haven't thought of yet, or whatever that may be. So prior to investing, I would anticipate having, conversations with anyone on this call. And in the past, Doug and or the other sponsors, other partners are also willing to get on those calls to ask, the super specific questions. But so I will probably follow up with each of you individually to field those. There's got to be a couple more good questions here, though.
You say it goes to Florida too? They're in Florida as well?
The Southeast. So the partner that is investing in 90s vintage apartment complexes is targeting the Southeast, which ends up being Alabama. They can go into Florida. They don't seem to be doing that anymore. A lot of it is based on, not a lot of it, but it is influenced by where there have been changes to the insurance structure that they cannot mitigate through their, that's a huge company. So they have master policies across the country, and then they have a lot more leverage on, between them and the insurers. But having said that, they're just managing their fund for the best return, and so they're going to seek out the cheapest places to run this strategy. The strategy itself is the same. That's one of the things that makes it so appealing, is they just do the same thing every time. So it's, they've been doing it for some of the people involved have been doing the same strategy for 25 years, and so it's just the same thing they keep doing over and over. Just to, so they're just finding the places that have the proper demographics. And funny enough, that multifamily asset class is one where Fannie and Freddie are still involved. So that's probably one of the things that I guess is driving the opportunity there. All the same lending and refinancing issues exist for current owners. So that's going to create buying opportunities, which is one of the main reasons I'm using that as a diversifier. So
It's
yeah.
Eric.
Go ahead, Eric.
Hey, going back to the data centers, the group that you said it was the Carter family group?
Yeah, it's the Carter family of funds, but that particular fund is the multifamily, or sorry, that particular fund is the critical infrastructure fund.
And they've been doing that a while, I guess, around.
Yes.
Okay.
No, they have not been doing it as long as their multifamily, but yes, they've been doing that for, I don't know, 5, 6 years.
Okay.
So it's not a phenomenon that has been, it's a recent trend, so it's a burgeoning part of the data centers themselves are not, but being able to buy these data centers from the corporations while you at the same time already have the terms negotiated. So by the time you're signing on the dotted line and putting the money up, you know what the terms are, and you're dealing with, the most recent one they bought was from Coke. Obviously, Coke is going to pay their bill and honor the terms on the contract. So it's, from that standpoint, the risk associated there is, in my opinion, pretty low.
Thanks.
Having a little bit of experience in this space, Sean, I think if this is what they're after, it makes sense to me, which is a lot of companies who have, usually a primary and a backup data center at a minimum, have been struggling for years as to whether they should shift significant amount of their computing power to the cloud, which would thereby shift a lot of the need for bricks and mortar to, a larger company like AWS or something to do the work for them. But it takes years to get that right. And so it's logical to me that a lot of companies would find it attractive to do a lease back while they work through the several year process of getting out of at least half of their data centers at a minimum. So.
Yeah, well, that proves that you're entrenched. So one of the things that this company is doing is advising them. So they have a third party that is advising them through that process. And in some cases, this is their plan. This is part of their plan for that process. And so, but that's exactly right. Yes, they're essentially not owning that process anymore and trying to figure out how to get out of it.
The trick is going to be not to get caught with, again, the data centers that become obsolete, because again, more and more computing power will move to the sophisticated cloud-based computing, and they won't need kind of these massive machines with lots of air conditioning, et cetera, that a lot of people have had for years. So.
Right. So you're tipping towards the exit strategy. So the income that's being produced on those assets is known. The exit strategy is what they are, where the value and or the, I guess the trick is. All right. Well, thank you, everyone. I anticipate having conversations with each of you. Save your questions for that time. If I get some different questions that I think are worth sharing with the group, I will add those in the Q&A. But each of you will get a recording of this and the presentation for whatever that's worth. But yeah, thanks a lot. I'll hang out for a little bit. Maybe Doug can hang out for a couple minutes just in case anyone wants to stick around and ask questions. But thanks for coming, and I'll talk to you guys soon.